If you're an Edexcel A-level business student looking for a video to revise all of theme 3.3 decision making techniques, well, this video is for you because we're going to go through everything that you need to know for your exams, including some very tricky calculations such as the quantitative sales forecasting. We'll also take a look at the 3 different methods of investment appraisal. Then we're going to move on how we use decision trees, and then finally we'll finish this session off by looking at our critical path analysis. Let's get into it. The first topic that we're going to be taking a look at in this revision video will be our quantitative sales forecasting. Now, earlier in theme 2, we did actually have a look at what a sales forecast is. But in theme 3 with quantitative sales forecasting, we go a little bit more in depth with actually how we start to conduct a sales forecast. But just to give a bit of a recap, all we mean by sales forecasting is when we use past data to try and predict future data. So when we are looking at past data, we want to try and identify different trends within the data. Now, looking at past sales data, it's not always that obvious to try and identify the trends because we may have data that is spiking really high, then the next month really low. But what we try and do is we try to calculate these moving averages because this will help smooth out the data so we can identify trends more clearly. Now, the first way of doing this is by calculating the 3-point moving average. Now, remember from your GCSE maths days, to calculate the average of something, you want to calculate the mean. And to do this, you add all the data together and then divide by how many there are. So when we look at the 3-point moving average, we want to find 3 points of data consecutively, add them all together, and of course divide by 3. So we will start by looking at 2023 quarter 1, quarter 2, quarter 3. So we add them all together. We do 150,000 plus 180,000 plus 210,000 and divide by how many there are, which is 3 points of data, which gives us that 3-point moving average of 180. Of course, £180,000, but to keep it simple, we just say it's 180. And then we do it again, 180 plus 210 plus 190 divide by 3, which will give me a 3-point moving average of 193. Then we do that again and again and again and again. I'm not going to go through all of them because by now you should be seeing what the pattern is. Now, how this starts to look like on a graph. Well, if we just had the data first, so not the 3-point moving average, just the sales data, we can see a bit of a trend. We know that it's going up to the right. So that identifies a growth within our sales. But as you can see, the data isn't that smooth. It's going up then down, up then down. But what that 3-point moving average looks like is that new light blue line on the graph. We can see that it smooths out the data and gives us a better trend line to follow. And the next one we have is the 4-quarter moving average trend. Now, this one is overlooked, but it still is in your specification. And this has been examined on before, and it threw a lot of students off. Now, don't let this table throw you off. We're going to go and break it down into a lot of detail. So we've still got the same data as before. You know, we've got 2023 and 2024 broken down each into 4 quarters. And then, of course, we've got the sales data. Then now what we want to do is we want to calculate the 4-quarter total. Now, we're not doing the moving average. We're not dividing it by 4. We're just looking at the total. So for 2023, we do Q1, Q2, Q3, and Q4 and just add them all together. Simple. Nothing too complex just yet. And then we do that again for the next set. So instead of doing obviously Q1, 2, 3, and 4 of 2023, we do Q2, Q3, Q4 from 2023, and then Q1 of 2024. Remember, we want to go consecutively. Then we do that again. We do 210 plus 190 plus 220 plus 250 to get me a 4-quarter total of 870. Then we do that again to get us a total of 890 and finally to get us a total of 940. And then what we want to do is we want to calculate the 8-period total. Now, we're not doing any averages just yet, so we're not dividing it by anything. But on there you can see we've got 5 4-quarter totals. Now, to get the 8-period total, you just add 2 of them together because 4-quarter total plus another 4-quarter total, 4 plus 4, gives us 8. Then we do that again. We do 800 plus 870 gives me an 8-period total of 1,670. Then we do that again. We do 870 plus 890 to get me 1,760. And finally, for the last one, we do 890 plus 940 to get me an 8-period total of 1,830. And then what we want to do is we want to calculate the 4-quarter moving average trend. Now, this is where students go wrong, because what they would do is they would get that 8-period total and divide by 4. But remember, that 8-period total, we've done that by adding 8 periods together, not 4. So remember, to get the average of something, you add them all together and divide by how many there are. So we do 1,530 divided by 8 to give me a 4-quarter moving average trend of 191.25. Then we do that again. We do 1,670 divided by 8 to give me a 4-quarter moving trend within Q4 2023 of 208.75. Then again to get me 220, and then again to get me 228.75. Now, the last thing that we need to do is to calculate the variation. Now, what that variation will tell me is, compared to the data actually recorded, let's say in Q3 for 2023, how far away was our 4-quarter moving average trend? So when we look for that line, we have a sales data of 210, but the 4-quarter moving average trend is only 191.25. So the variation would be 18.75. We just minus one from the other. Then we do the same thing again. We do 190 minus 208.75 to give me a variation of minus 18.75. Then again, for our Q1 of 24 to get me a variation of 0. And finally, to get me a variation in Q2 of 2024 of 21.25. Now, the idea with the variation is to try and identify any seasonality. So when we are looking at that 4-quarter moving average trend, we can start to identify, well, what was happening in Q3 and Q4? Why was one of the variations positive? Why was the next one negative? Maybe we've got a bit of seasonality within our demand. The next thing that we need to do in our quantitative sales forecasting is to introduce this concept of extrapolation. Now, on the screen, you can see some past data I have in terms of the business's revenue. So over time, the revenue is starting to increase. Well, what I want to do is I want to draw the line of best fit. And the line of best fit shows the trend with the data. And this can also be called the regression line. Essentially, it's just the median point for all of that data to identify, well, what's happening. Now, from that line of best fit, it's really clear to see that over time, the revenue is increasing. So when I want to look at calculating the sales forecast, all I need to do now is to continue that trend. So as you can see, that green line there, it starts to increase. And just to summarize this, all we are doing with extrapolation is a process of using past data to try and predict or forecast future values by extending that trend or pattern. Now, the issue that we may have with extrapolation is that, well, potentially we're assuming that the future conditions will be the exact same as the past, which is never normally true. And of course, whenever we are trying to predict something, we have to appreciate the fact that we can never 100% guarantee that it will actually be the case. Now, the last thing that we need to do with our quantitative sales forecasting is just to identify the limitations. As we were mentioning just with extrapolation, I think the biggest problem with quantitative sales forecasting is, remember, you're using past data to try and predict future data. Now, the problem with this is that you're assuming that those past conditions will be the exact same as the future. So imagine that I was conducting a sales forecast at the start of 2020. I looked back on the year of 2019, I saw that the business was growing, the economy was growing as well. So my sales forecast would state that we're going to continue with our sales growth. But of course, the external environment dramatically changed. We had COVID, we had lockdowns. So when you are evaluating your answers, make sure to include this, that the issue with this is that you are assuming future conditions will be the same as the past, which is rarely ever the case. And another problem is that you are using past data to try and predict future data. Well, first of all, what if you don't have any data? If you are a startup company, having these sales forecasts can be quite difficult to make. And finally, another thing that you guys can include in your evaluation is that the further you go into the future, the more unpredictable that external environment is going to be, so the more inaccurate the sales forecast typically will be. The next topic that we're going to take a look at in this revision video is the dreaded investment appraisals. Now, for your exams, we need to know the 3 different ones: payback period, average rate of return, and the net present value, also called the discounted cash flow. Let's break each of these down, how we calculate it, what they are, and also the advantages and the disadvantages of using each. starting off with the payback period. Now with any investment, there's going to be this upfront investment cost into the actual project or into the actual capital. Now with the payback period, what we are trying to calculate is, well, how long is it until I recoup that investment? So if I invest £500,000, how long is it until I get my money back? So essentially what we want to identify is, when do we hit our net zero? Because that will tell me how long it would be until I've recouped that investment. Now, to calculate this, I'm going to show you a step-by-step process. Now on the screen here, you can see a cash flow forecast going forward, and it starts off at year zero. The reason it starts off at year zero is because that shows the investment into the project. Now in your exams, they may just give you your net cash flow, but they can give you this. Now remember, from your theme 2 days, how we calculate our net cash flow, we just do the cash inflows minus the cash outflows. So I'm not going to go into too much detail with how to do this, but the one thing I do want to know is that when we have a negative value, we express that within brackets. So as you can see, we have our net cash flow for our project. Now, this is where we start to calculate our payback period. Now, to do this, we draw on an additional column called the cumulative cash flow. And essentially, we go year by year, adding on the data. So let me show you how this works. For year zero, I take the net cash flow from year zero, which is at minus 450,000, and shift it to the right, because that's where my cumulative cash flow starts. Then all I want to do is add on the following year's net cash flow. So we do minus 450,000 plus 50,000 to get me a cumulative cash flow of negative 400,000. And then we continue this process. We do the exact same thing again. We do minus 400,000 plus 85,000 to get me a cumulative cash flow of negative 315,000. And you can see here our cumulative cash flow is minus 185,000. And we do it again. Our cumulative cash flow is minus 35,000. But with the last one, as you can see, it goes now to positive 190,000. Now remember, with our payback period, all we want to identify is, well, how long is it until I get my money back? How long is it until my cumulative cash flow hits zero? The problem is that I don't exactly know when it hits zero, because we go from minus 35,000 to positive 190,000. So all I know is at this point in time is that my payback period is somewhere between year 4 and year 5. Because of course, when you go from a negative to a positive, at some point you had to hit point zero. So how do we go about then calculating the exact month of the payback? Well, we've got our formula here. So the way we calculate this is that we want to figure out, well, how much is it until our cumulative cash flow hits zero, and divide that by the following year's net cash flow. And then we of course times by 12 to get the exact month. Now, the reason why we do this is because, as you can see here, we know that at the start of year 4, my bank balance is negative £35,000. But of course, at the end of year 4, going into year 5, it goes to £190,000 positive. Now, across that year, I received £225,000. And what we are doing is that I'm assuming that I get an equal amount each month. So in month 1, in January, I get a 12th of that £225,000. In month 2, so in February, I get another 12th of that £225,000. So what we want to figure out is, how long is it until we hit that specific month of payback? So all I need to do is, I take £35,000 divided by £225,000 times by 12, because of course that's how many months there are within the year, and that gives me 1.86 months. So my payback period for this project, it takes 4 years and 1.86 months until I recoup that initial investment. Now, the payback period is actually a really useful investment appraisal because it helps the business prioritize quick returns to improve their cash flow. Because within these dynamic markets, where we know the market's changing quite rapidly, well, the longer the payback period is, the more uncertainty we have. Because imagine this payback period isn't going to be until 10 years. Well, we don't know what's going to happen over the next 10 years because artificial intelligence might take over. The project that we're investing in might become obsolete. So when we are trying to compare different projects, well, the criteria is going to be simple. Choose a project which has the quickest payback period. However, there is a problem with the payback period is because we kind of ignore what happens after it. So as you can see with this project here, and I will come back to this slide, is that all we know from the payback period is that it's going to take us 4 years and 1.86 months until you get your money back. But after that period, well, how much money do we actually make? The issue with the payback period is that it just doesn't tell us that. It doesn't look at the entire project, it doesn't look at the profitability of the project, or it doesn't look at the total return. It just focuses on how long is it until you get your investment back. And you are just prioritizing having this short-term gain. Because if I have two different projects, project A with a payback period of 2 years versus project B, which has a payback period of 5 years, well, of course you're going to go for project A with the payback period. But what it doesn't tell me is that project B has a return of over 10 times the amount of project A. So that is a limitation of the payback period. The next investment appraisal that we're going to take a look into will be the average rate of return, also known as ARR. Now with the average rate of return, this is more so looking at the profitability of a specific project. Because what we do is we calculate the average annual return of an investment as a percentage of the initial cost. That might make no sense, and I'm going to show you a formula and you're going to think, oh my god, I've got no idea now how to do this. Don't worry, we're going to break it down step by step. Now to calculate the average rate of return, there's two things we need to do. First of all, we need to know what the average profit of the actual project is. Then we take that and divide it by the initial investment. And of course, we said we want to express this as a percentage, so we times by 100. So the formula will be, you do the overall profit of the project, divide by the number of years. That will give me the average profit per year. Then we take that figure, divide by the initial investment, times by 100 to get a percentage. Now I'm going to show you the step-by-step method to how to calculate the average rate of return. Now you can in theory just add the net returns column together. However, I would advise for you to do the cumulative returns. Because I know there's been students in the past where they've tried to add in one line of their calculator, minus 600,000, plus 85,000, plus 125,000, plus 150,000, plus 190,000, plus 275,000, all into their calculator all at once. Now the problem is there's a good chance that you end up adding a zero where you shouldn't or not having a zero where you should. So this is the very basic step that you don't want to mess up. So what I would advise, do the cumulative returns. Start off with that minus £600,000. And then what you want to do is do the minus 600,000 plus the £85,000 to get me a cumulative return after year one of negative 515,000. Then we do this again and again and again and again until we get the final cumulative return after the 5 years. Now the cumulative return after the 5 years, after the entire project, will actually be the profit of the overall project. Now remember, when you're calculating the profit, you have to factor in that initial investment. Now the second step that we need to do is to calculate the average annual profit. The way we do this, we take the profit of the overall project and divide by the number of years to get the average annual profit. So on average, how much profit am I making each year? Now, as we said, the profit for this project will be the £225,000 and we've got 5 years. So we do 225,000 divide by 5 to get me an average annual profit of £45,000. Now, all we need to do now is to take the average rate of return, is that we take that number and divide by your initial investment times by 100 to get it as a percentage. So all we do, £45,000, the average annual profit, divide by that initial investment of £600,000 and then times by 100 to get 7.5%. Now just be careful with that initial investment. Don't treat it as a negative number, just treat it as a positive number for this calculation. Now the average rate of return is an amazing investment appraisal because we look at the profitability of the entire project. Now the issue is with the payback period, as we spoke about earlier, is that we only consider, well, when is it until we get our money back? We don't actually look at the data after the payback period. But with the average rate of return, we look at the entire project. So it's really useful for us with that long-term investment planning. However, the problem is that we are assuming consistent profits throughout the investment. Don't worry, I'm going to come back to this slide. But as you can see here, our average rate of return tells me I'm going to be making 7.5% per year from that initial investment. The problem with that is when we look at this data, we can actually see it's not until the 5th year until I make any profit. But that 7.5% is assuming that I'm making 7.5% profit compared to that initial cost every single year. And that's not true because I'm only making profit within the 5th year. And it's an amazing tool to compare different investments against each other. Because if I had project A with an ARR of 5%, project B with an ARR of 20%, of course I'm going to go with project B. But it can be subjective because if I'm just looking at whether to go forward with this one investment and I've got an average rate of return of 12.5%, well, is that good? I don't know. The average rate of return, whether the rate is successful or not, can be subjective. And the very last investment appraisal that we need to look at is the discounted cash flow, also known as the net present value. In my opinion, this is the easiest one to calculate out of all of them, and I think it's probably the best tool to use. Now, what we do within the net present value is that we appreciate that over time, money loses its value. Because you may have been asked this question before, would you rather have £50,000 today or £50,000 in 5 years' time? Most of you would say today because I want to spend the money now, but the actual thing that we need to look at is, well, how much is that £50,000 in today's world going to be worth in 5 years' time? Because we know there's factors such as inflation. And of course with inflation, from what we've learned on theme 2, causes the purchasing power that money has to lose value over time. So that £50,000 today could only be worth £28,000 in 5 years' time because inflation makes it loses its value. So within the net present value, essentially what we are trying to do is in today's world, how much is this project going to return me? And the way we calculate this is we use these discount factors. Now these discount factors will be given to you in your exam, so do not worry about how to calculate them. But what the present value does, it helps us understand, well, in today's world, how much is that net cash flow going to be? More on this in just a moment. So as we can see, for year 1, the discount factor would be 1 because we're talking about in today's world, well, minus £600,000 today is going to be worth minus £600,000. So how we calculate the present value is we take the net cash flow and multiply that by the discount factor. And then we're going to do the exact same thing for year 1. So after 1 year, we do £85,000 of the net cash flow times by 0.92 to get me a present value of £78,200. And what that basically means is that £85,000 that we record from 1 year from now in today's world is only worth £78,200. So it's not as worth as much as we thought it would be. Then we do the exact same thing for year 2. So we do the net cash flow, £125,000, multiply the discount factor 0.84, gives me a present value of £105,000. So once again, what that tells me is that that net cash flow that we're recording in 2 years' time of £125,000 in today's world is only worth £105,000. Then we do the same thing for year 3, year 4 and year 5. Now we've calculated the present value column, but remember we want to calculate the net present value. And the way we do this, imagine you're casting a net over all of the present values. So all we want to do here is that we want to add that column together. So we do minus 600,000 plus 78,200 plus 105,000 plus 115,500 plus 134,900 and then plus 178,750. And then once we do that, we get a net present value of £12,350. So what we're saying is that project in today's world will return us £12,350. Now we've got a real simple criteria about whether we want to go ahead with the project or not. If the net present value is positive, then we accept the project. But if the net present value has a negative value, then we want to reject it. Now, of course, if you're comparing 2 projects against each other, then you go with the one which has the highest net present value. Now, out of all the 3 investment appraisals, I would say the net present value carries the most value because it factors in the time value of money. It accounts for the fact that over time, money loses its value because of factors such as inflation. So let's say, for example, you had 2 projects. Project A, both the ARR and the payback period was more favourable, but for Project B, the net present value was more favourable. I would technically argue Project B is probably the better project to go invest into. And as well, what's great about it is that we're once again are considering all the cash flows of the investment, not just until we have our money back like the payback period does. However, the problem is with the net present value lies with the discount factors. Because yeah, I've told you guys that you don't need to calculate them for your exams, but you need to know how to effectively evaluate them. Because when we look at the discount factors, as we said, they try and account for stuff like inflation. But how do we know what inflation is going to be? How do we know that inflation might not be higher or might not be lower? And this is the issue. Getting to the discounted factors can be quite subjective, as they may not always reflect real economic conditions. Just a quick one, if you need a bit more support with your exam technique, such as how you improve your analysis, how to apply more within your answers, and how to evaluate more, well, I've created a free exam technique course that helps you with this. It also goes through the key answer structures that you need to follow for your exams, including those 4 markers, 8 markers, 10, 12, and those dreaded 20 markers. You can access this exam technique course for completely free using the link in the description. Back to the video. The next topic that we're going to take a look at in this revision video will be our decision trees. Now, it's within the name. A decision tree helps a business make a decision, because we may have, once again, 2 different projects that we could invest into. We could invest into project A, or we could invest into project B. A decision tree will help us evaluate it. It will help us calculate the expected value and the net gain of each of the options. But what's specifically important about the decision trees is that it starts to incorporate risk, because we incorporate these probabilities of, well, what's the likelihood of the project actually being successful versus unsuccessful. More on that in just a moment. But what we're going to do to start off with is how we actually calculate our decision trees, so how we calculate the expected value and the net gain. Now, this is what our decision tree would look like. And as you can see here, we have 2 different investments. So we're looking to invest £35,000 into a promotional campaign. So that red number in brackets represents the investments. And of course, in brackets, because it's a negative, we're investing it into it. Or the second option is looking at investing into a new product, and that's going to cost us £40,000. Now, there's a couple of things that I want to draw your attention to. We have these 2 branches coming off each of the options. So for option 1 of that advertisement campaign, we have a 0.4 and £100,000 and 0.6 and £10,000. Well, essentially what that is telling me is that there is a 40% chance likelihood that the project does really well and we're going to make £100,000 from it. However, there's a 60% likelihood that we're not actually going to do that well and we're only going to have £10,000 from the advertisement campaign. Now, with these probabilities, they should add together to give us 1, because either one of the 2 options is going to happen. And with our new product, as we can see, there's a 30% chance likelihood that it does really well and we make £150,000, or there's a 70% chance likelihood that we only make £1,000 and it doesn't do too well. But what's interesting about this specific decision tree, and it may be replicated in your exam, is that actually you're comparing a market penetration strategy to a product development strategy from Ansoff's matrix. Now, as you could imagine, the product development strategy typically carries more risk than the market penetration strategy. So keep your eye out for that in your exams if they do test on it. Now, what we want to do is we want to calculate the expected value. And to do this, we take the probability times by the expected outcome. So we do 0.4 times 100,000 gets me an expected value of £40,000. Do that same again for the second branch. 0.6 times by 10,000, which gives me an expected value for £6,000. Do the same thing again for option 2. We do 150,000 times 0.3, which would give me £45,000. And then last but not least, 0.7 times 1,000 gives me £700. But we want to know what the total expected value is, so we need to add these both together. Gives me an expected value of £46,000, and we do the exact same thing for option 2. We do 45,000 plus 700 to give me an expected value of £45,700. Now, the next thing that we need to do is calculate the net gain, and this is the important part. So we know that our expected return for option 1, factoring the probabilities of risk, is going to be £46,000. But remember, we have that initial investment into it. We spent £35,000 on the advertisement campaign. So what we want to do is we want to take that negative £35,000 and minus it from that expected value to get us the net gain. So we do the £46,000 minus £35,000, which would give me a net gain for option 1 of £11,000. Do the exact same thing for option 2. We've got that initial investment. So when looking at option 2, we do 45,700 minus 40,000, that initial cost, which gives me a net gain of £5,700. Now, when choosing which option we should go for, you go for the option with the higher net gain. However, this is where you guys need to evaluate, because yes, the net gain is going to be higher for option 1. However, If the option 2 was successful, we're going to make £150,000. If option 1 is successful, we make £50,000 less. Yes, it's more risky, but the returns might be a lot higher. Now, as we said earlier, decision trees are brilliant. They're great tools to help us evaluate different options and see which one we want to invest into. But they are not without their problems. Now, of course, I showed you earlier that, well, there's a 40% chance likelihood that the advertisement campaigned as well. Well, what's the accuracy behind that? We are just factoring in a bit of a prediction realistically. Well, I think it's going to be a 40% chance likelihood that it will do well, therefore a 60% chance likelihood that it won't do well. But what's the accuracy behind that? And this is the issue. It's because the overall reliability of your decision tree will depend on the data used. Because once again, what is the likelihood that I am going to make £100,000 if it is successful? Why isn't it more? Why isn't it less? So when you are evaluating it, it depends on how accurate the data is and how accurate those probabilities are. And the last topic that we need to take a look at in this revision video will be the critical path analysis. Now, there's a lot we need to take a look at. We need to identify what a network analysis actually is, how we calculate the earliest start time, the latest finish time. We need to identify what the float time is, how we identify the critical path, and also evaluating it. So there's a lot of detail that we're going to take a look into. First of all, we need to identify what a network analysis is. Now, this is what one looks like. Now, I know what you're thinking. Oh my goodness, there's lines going everywhere. There's letters here, there, and everywhere. And there's also lots of different numbers. Do not worry, we're going to break down each of this in its most simplistic form. But all a network analysis is, we use this to plan and control complex tasks or projects by identifying the sequence of activities that are critical for completing the project in the shortest time possible. Now, as we said, it's widely used for completing projects. Typically in fields like construction, so making a building, for example, in engineering, in event planning. So the idea is we want to complete the project in the shortest time possible. You may ask, well, why? Why do we want to complete it in the shortest time possible? Well, quite simply, the quicker we do this one, the quicker we can move to the next project, the quicker that we can realise the cash that we get for this. Not only that, we may be paying employees on a daily rate. Well, the longer the project, the longer that you'll have to be paying them. But it's not just about rushing the project, it's about doing it really efficiently and allocating your resources efficiently as well. But now let's start to break down this network analysis. Well, remember, in that network analysis, you've got loads of these different circles going here, there, and everywhere. Well, within those circles, first of all, we've got a node. And all these nodes do is they connect our tasks and activities together. Then when we look at the right side, in the top half, we've got the earliest start time. And in the bottom half, we've got the latest finish time. Do not worry, we're going to break down what these mean in just a moment. And what we'll see is we've got lots of different nodes on this project. Well, when you see a specific letter, that represents the activity or task that needs to be done. And when you see the number on that line, that's the duration. Whether it's days, whether it's weeks, whether it's months, who knows, depends on the specific project. Now, as I said, we're going to break down the earliest start time and the latest finish time. Starting off with the earliest start time. Well, quite simply, all the earliest start time is, it's the earliest point in time where a task can begin. That's all it means. The earliest start time is how early in this project can we start this specific task. Now, there will be certain tasks that require other tasks to be completed. So, for example, I can't start task B until task A has been done. Well, if task A takes 5 days to complete, well, the earliest start time for task B is just on the 5th day, because it can only start once those preceding tasks have been completed. And the way we calculate the earliest start time is quite simple. You go from left to right and you start adding. So to get the earliest start time in node B, you do the earliest start time in node A plus the duration. That is all you do. So for example, the earliest start time that task D can start is on day 0, so you can start straight away. Now task D takes 10 days to complete. So the earliest start time for task E is on day 10, because task E can only start once task D has been completed. Makes a bit of sense. And now let's look at the earliest start time for task F. Well, task F can only start once task E has been completed. Well, if task E starts on day 10, takes 9 days to complete, well, 10 plus 9 gives me 19. The earliest start time that task F can start is on day 19. And now to calculate the total duration of this project, well, task F starts on day 19, takes 5 days to complete, 19 plus 5. Well, overall this project will take 24 days to complete. Now, it's going to be very rare that you've given something as simple as that in your exam, because typically you'll have multiple predecessors. Now, you might ask, well, what on earth do I mean by multiple predecessors? Well, it looks something like this. Essentially, task D can only start once task A, B, and C have been completed. But the thing is with task A, B, and C, they can all happen at the same time. They don't depend on each other. So task A starts on day 7, takes 10 days to complete. Task B can start on day 8, takes 7 days to complete. Whereas task C can start on day 6, but takes 4 days to complete. Now, when you are looking at the earliest start time for task D, you want to add all these numbers up together and take the highest one. Now, try not just to remember, okay, take the highest one. I want you to fully understand why we need to take the highest one. Because look, we've done the earliest start time calculations for A, B, and C. So looking for task A, starts on day 7, takes 10 days to complete. Earliest start time for task D could be on day 17. We do the same thing again for task B. Starts on day 8, takes 7 days to complete. The earliest start time for task D could be on day 15. We do the same thing again for C. Task C starts on day 6, takes 4 days to complete. The earliest start time for task D could be on day 10. Now, the reason why we take the highest number is because we need all of those activities to be completed before we start task D. Because if you think about it, well, if I took C, for example, and I did the earliest start time for task D on day 10, well, task B or task A haven't been completed yet. That is why we take the highest value. And now let's do a step-by-step process of doing these calculations. So we always start on 0. Projects always start on day 0. Now, when we look at the earliest start time for task D, we need to do the earliest start time of task A plus the duration of task A. So you do 0 plus 8 equals 8 for that node 2. Now, the earliest start time for both task E and F, well, that would be on node 3. And remember, task E and F can only start once task B has been completed. So you do 0 plus 10 gives me 10. So the earliest start time for both task E and F is on day 10. Then you do the same thing for task G. Now, task G can only start once task C has been completed. So you do 0 plus 4 equals 4 in node 4. But now have a look at node 5, because when we look at the earliest start time for task H, well, it depends because we need to now complete both task D and D. So we do both of those additions. So the earliest start time, earliest point in time that task D can start is on day 8. It takes 12 days to complete it, so we've got 20. And we do the same thing for E. Well, E can start on day 10. And it takes 6 days to complete, so we 10 plus 6 equals 16. Now, after day 16, task D is still going on, so we have to take the highest earliest start time. So the earliest start time for task H is on day 20. You do the same thing again for node 6 for task I. So the earliest start time for task F is on day 10, takes 5 days to complete, so we've got a calculation of 15. Whereas we look at task G, well, it can start on day 4, takes 10 days to complete, so it will be completed after 14 days. Well, remember, we have to take the highest value because both of those activities need to be completed. Therefore, earliest start time for task I is on day 15. And then we do the exact same thing again for the earliest start time for task J. Both task H and I have to be completed. 20 plus 8, 28, 15 plus 2 equals 17. You should know by now you take the highest value. And to get the overall project completion, we need to do task J, earliest start time, day 28, plus its duration, 5 days, which would give me an overall project completion date after 33 days. Now, the latest finish time, this works a little bit differently. But first of all, let's define what we mean. Now, all we mean by a latest finish time is the latest point in time that a certain task or activity has to be completed by, because if it is delayed even by a single day, the entire project would therefore be delayed. So to go over that definition, the latest finish time is the latest point at which a task can be completed without delaying the overall project. Now, when we are calculating the latest finish time, we go from right to left. So we look here for the latest finish time in node A. We do the latest finish time in node B, which is just the latest finish time of task D, minus the duration of task D. So let me give you some examples. When we look at the latest finish time on task E, well, we take the latest finish time of task F, which is on day 24, minus the duration of task F, which is on 5 days, which would give me 24 minus 5 equals 19. So the latest finish time of task E is on day 19, because if task E is delayed even by 1 day, so task E doesn't finish until after 20 days, well then that would delay the entire project by 1 day. So instead of completing it within 24 days, we complete it within 25 days. And just simply do the same thing again. The latest finish time for task D equals the latest finish time for task E minus its duration. 19 minus 9 gives me the latest finish time for task D of 10 days. And we do the same thing again, but what you'll find is that the early start time and the latest finish time at the very start of a project will both be 0. Now, like I said earlier, it's going to be very rare in your exams that they give you such a nice network analysis, because what they might give you when you're calculating the latest finish time is that it may give you multiple successor tasks. Now, what does that mean? And essentially, task B, C, and D can only start once task A has been completed. So when we are calculating this, remember we start working from right to left. So what is the latest point in time that task A must be completed by without delaying the overall project? Now when we calculate the earliest start time, you take the largest number. But when you calculate the latest finish time, you now want to take the lowest number from these calculations. I'm going to explain why that is. Well, let's do it. So the latest finish time for task B can be on day 24. It takes 10 days to complete it. So you do 24 minus 10, which would give me a latest finish time potentially for task A of on day 14. Because if task A was to finish on day 14, you could still complete task B within that deadline. But what about now for task C? Well, looking at task C, it must be completed by day 17. It takes 7 days to complete it, so it must start on day 10. So when looking at task C, it has to start by at least the 10th day. So now, if we was going to take the latest finish time based on task B, so task A only finishes after the 14th day, well therefore task C would therefore have to be delayed, because it says for task C to be completed by that 17th day deadline, it has to start on day 10. But now let's do the same thing for task D. Well, task D has to be completed by day 9. And if it takes 4 days to complete, well, the latest finish time now for task A has to be on day 5. Because if task A was even delayed by 1 day, so let's say task A doesn't get completed until day 6. Well, if task D starts on day 6, it wouldn't now be completed until day 10. So what you have for the entire of your project is now an overall delay. So let's have a look at calculating our latest finish time from that network analysis we did earlier. Well, for the very last one, the latest finish time and the early start time is exactly the same. Now, when looking at the latest finish time for both task H and I, well, you do the latest finish time of task J minus its duration. So 33 minus 5 gives me day 28. Now looking at node 6, so we want to look at the latest finish time for both task F and for task G. Well, quite simply, latest finish time of task I is on day 28 minus its duration. 28 minus 2 gives me day 26. So task F and G have to both be completed by day 26. We do the same thing for task D and E, looking at node 5 now. We do the latest finish time of task H, 28 minus its duration of 8. Well, just gives me day 20. So now we'll look at doing node 4, so the latest finish time of task C. Well, we know that the latest finish time of task G is on day 26, takes 10 days to complete. 26 minus 10 equals day 16. So what we're saying is, as long as task C is done by day 16, everything else, the project won't be delayed. Then we're going to jump straight up now to node 2. So we're looking at the latest finish time of task A. Well, the latest finish time of task D is on day 20, takes 12 days to complete. 20 minus 12 gives me 8. So now we're looking at node 3. So we're looking at the latest finish time of task B. Well, we've got 2. We've got E being completed and we've got F being completed. Well, task E has to finish by day 20. It takes 6 days to complete, so in theory the latest finish time for task B could be on day 14. Now looking at task F, well, task F has to be completed by day 26. It takes 5 days to complete. So task B, the latest finish time for that situation, has to be on day 21. But once again, we take the lowest number, because in order for task E not to be delayed, it has to be finished at the latest point on day 14. And quite simply, for the very last one, it will always be 0, 0. Now, throughout those sections of calculating the earliest start time and the latest finish time, I've been saying about, well, some tasks can be delayed. And figuring out how much a task can be delayed by is essentially what we call the float, or the total float time. And all it means is the amount of time a task can be delayed without affecting the overall project completion date. The way we calculate this is we take the latest finish time of that specific task or activity minus its duration minus its earliest start time. So to give you guys an example of this, looking at task D here, well, the latest finish time for task D is on the right side, the earliest start time for task D is on the left side. So the latest finish time for task D has to be on day 28. Its duration is 10 days, that's how long it takes to complete, and its earliest start time is on day 10. So in theory, task D can be delayed by 8 days, but it still gets completed. Which makes a lot of sense because I can start task D on day 18, takes 10 days to complete, 18 plus 10 gives me 28, which is in line with the latest finish time. And now I want to introduce you to the main concept of all of this, which is the critical path. Now, what the critical path is, this is the longest sequence of tasks in a project that must be completed on time to ensure the overall project is finished by its deadline date. So any task that is on the critical path has 0 float time. It cannot be delayed. Now, spotting this is quite easy. Rather than you calculating all of the float times for the different tasks and activities, what you'll find is that the EST, the earliest start time, and the latest finish time within the node will be exactly the same. I'll show you an example in just a moment. But as I said, any task that is on the critical path has a 0 float time, which means these tasks, these activities cannot be delayed. Because if they are delayed even by a single day, the entire project would therefore be delayed. So showing you how to identify the critical path, well, if we look here, well, task A, that's on the critical path. Because the latest finish time found in node 2 is 8 days, minus its duration of 8, minus obviously the earliest start time of 0, 8 minus 8 is 0. But if you look at node 2 and node 1, both the earliest start time and the latest finish time numbers are equal to each other. Because obviously in node 1, EST and LFT are both 0, and for node 2, both the EST and the LFT is 8. Well, if you look after A, well, task D comes, so that has to be on the critical path. And after task D, we've got task H, and then finally we've got task J. So the critical path is task A to D to H to J, because none of these tasks can be delayed. If any of them are, the overall project would be delayed. And if you add their duration together, 8 plus 12 plus 8 plus 5 gives you the overall project duration. And the very last thing that we need to do now with our network analysis is identify the limitations of using them. Well, first of all, remember, this is a plan. We're project planning. So all of these that you're looking at in terms of the durations, they are estimates. They are prone to inaccuracy. Now, in your exams, find out who's made them. Because there was a question not so long ago where you had to do the network analysis. But what it said within the case study is that, well, this was made by a startup entrepreneur who doesn't have that much experience. So what you want to do, you want to figure out, well, who's making those estimates? It also may not account for uncontrollable external changes. So depending on what the project is, those external environmental influences could delay any activity or task on the network analysis. And as well, the problem with network analysis is that it may not consider resource availability. Because let's say we've got task A, B, and C all happening at the same time. Well, the problem that we may have is that we need the same resources on all of those tasks. Well, task A would take priority because that might be the critical path. But if we don't have the resource flexibility, task B and C could overall therefore be delayed. If you want to carry on your theme 3 revision, I highly recommend you check out our video here on theme 3.4 influences on business decisions. As we're going to go through some real important concepts such as organizational culture, Handy's corporate culture model. We'll also take a look at business ethics, the shareholder versus stakeholder approach, and much more. I hope this video has been helpful for your revision. Thank you so much for watching, and I'll see you in the next one.